Hey everyone, welcome to Solving the Riddle, the podcast that unpacks the financial puzzles shaping your future. I'm Andrew Whitewood, and together with Alec we explore the ideas, behaviors, and strategies that help people make smarter financial decisions and build lasting wealth.
Welcome back to the Solving the Riddle podcast, and what an exciting episode we have for you today. This week, the Just Retirement Insights survey is dropping, and we already have sight of some of the amazing stats. So if you are about to retire or in retirement, or you are an adult with elderly parents, you really need to follow us through on this episode. We've got a specialist, Bjorn Ladewig, who's going to be joining us to talk about the survey. But just very quickly, Andrew, out of the survey came that a typical retiree has about a 48% shortfall going into retirement. It's quite a staggering statistic.
Yeah, Alec, and welcome back, everyone. We know the challenges that retirees are facing out there. We are facing a retirement crisis in South Africa. I think some other stats that we picked up outside of the survey are that 94% of South Africans cannot afford to retire, Alec. And I think the big challenge that a lot of South Africans are naturally facing is that they are leaving their retirement decisions too late. And I think the key thing that you and I are focusing on in this podcast is also the youngsters out there, the youth, the 20-year-olds, the 25-year-olds. They need to start saving a whole lot earlier, Alec.
The other thing is what came through in the survey is that, and I think there were about 450 people interviewed. It's quite a big sample size. And what came through is that they are saying if they run out of money, they will rely on children, family, and that's about 50%. So if you do not want to have to knock on your children's door, you really need to be listening to what Bjorn is going to be sharing with us a little bit later. And as I mentioned, if you're Andrew's age and you've got an elderly parent who perhaps doesn't have enough, make sure that you listen, because there are ways to change the retirement runway. You can prolong the length of a retirement journey by utilizing what we are going to be speaking about in this podcast. And of course, in the past, you used to have a pension fund. You know, your parents or your grandparents were a pension fund. They would have an income for life with escalations. That has fallen by the wayside. We now find 85 to 90% of people going into retirement are using living annuities. Great products, but they rely a lot on the markets. And we want to talk about perhaps a blend of the two.
Totally agree, Alec. And I think the whole retirement sphere or space is changing, right? We've had many conversations around this. A lot of people focus on that line in the sand, age 60, for example, or age 65, right? And they flip into retirement. And then there's challenges, obviously, from an emotional, psychological point of view. But what we are seeing with a lot of people now building up to retirement, obviously employment has changed dramatically out there. People aren't working for the same employer for example, for 40, 50 years, etc. And like you say, then they retire via a defined benefit scheme. A lot of people are now on defined contribution schemes. And the thing is, they are phasing into retirement, Alec. They are no longer just drawing a line, like I said a little bit earlier, at age 60 or 65. They are working maybe from 65 to 75, doing some consultancy work, etc. And like you rightly said, now you've got a living annuity, you've got a life annuity, we've got to unpack a blended annuity, but you've also got to take into consideration other income streams, Alex. So in my world, and we share a very similar view, is the retirement sphere is changing rapidly, and you've got to start rethinking sooner rather than later how you implement your retirement planning framework, your decision-making process, and your financial plan at the end of the day.
And retirement, of course, is not just about income and capital. It's about dignity, it's about independence, it's about legacy. And I always say to my clients, the greatest legacy that you can leave to your children is not to have to knock on their door. And that is what we're going to be talking about. So we're going to break for a moment while we welcome Bjorn on set, and let's get the specialist in as soon as possible and bring you some very insightful insights from the Just Retirement survey.
Hey Bjorn, thank you very much for coming on to today's show. Starting point, I think we'd like just to for you to introduce yourself to everyone. I know, obviously, I met you about 7 years ago in Cape Town. I know that you live in Melkbos, but I think for our viewers, our subscribers, and everyone that obviously listens to the podcast, please, just a little bit of personal background, just to warm everyone up.
Okay, thanks, guys. And thanks for having me here today. It's awesome. My name is Bjorn. I work at a company called JustSA, and we are retirement income specialists. But enough about that. I live in Melkbos, as Andrew says. And I really love the ocean, play a bit of paddle, have 2 lovely kids, and just live life happily and have a passion to make sure people have enough income in retirement. That's
So you
me.
say you play a bit of paddle. I think that's a bit of a understatement.
I've heard you're pretty good at this game.
I try. I really enjoy it, guys. It's something that you can try, but make sure you stretch. Don't break those Achilles, but give it a go. It's good fun, and I'm sure it's going to keep me living long.
And Bjorn, just a little bit of background. How long have you been in the industry for? What's your background from an educational point of view? I think you're an actuary. I might be wrong. I don't know if that's a good or a bad thing.
Yeah, I was waiting if someone's going to drop that today. Yes, I'm an actuary. I started in 2000, so nice round number. Been around the world, South Africa, Germany, Switzerland. Have actually been very involved in longevity solutions throughout, insuring them, reinsuring them, structuring, pricing them, and lately selling them. So just having a lot of fun with that.
Awesome. And Bjorn, you would have heard a little bit earlier, Alec and I were speaking about living annuities, life annuities. I mentioned specifically blended annuities or solutions. I think that's a good starting point. You've spoken about longevity solutions, so that might be quite a complicated term. So let's just start there. What do you mean about longevity solutions? And then I think what we need to do is unpack a living annuity, a life annuity, and then move on to the blended annuity.
Absolutely, and that's where the rubber hits the road, right? We have these lofty words, but in the end, it's about what really matters and what clients need. And let's talk a little bit about what a life and a living annuity is. Those are 2 products in South Africa that when you come out of your working career and you retire, you have to pick one of these 2 products. A life annuity is a very simple product. It turns your savings into an income for life. It's guaranteed. There are different types, but basically it won't stop paying, and it's generally not affected by market conditions. The other one is called a living annuity. Great product, flexible. I always explain it as a bit of a bank account. Not that you would only invest in cash, but it's a bank account from which you then choose how much to draw down. That varies from 2.5% to 17.5% is what is allowed. And that then gives you great flexibility. And on the day you die, you leave money to your beneficiaries. But of course, in that, because it doesn't have a guaranteed component, you have to plan carefully and make sure that you draw down at levels that are sustainable. So those are the 2 products.
So let's touch on the safe drawdown rates. So we've heard, and very often coming out of America, is the 4% rule, which you want to unpack, because I know you talk about the 25 and the 300 number, but I just want to touch on drawdown rates, and we in retirements in South Africa, that generally in the living annuity space, retirees are drawing out 7+ % per annum. The problem with that, if you're going to get an increase to counter inflation each year, that income will only last for 13 years. So retirees are going to hit a brick wall. When you say that's the average, it means that 50% of retirees are in trouble and they don't even know about it. So if you just want to explain, of trying to get down to 5 or 4%.
Yeah. And that's really, really important to think through those things. So we spoke about a safe drawdown rate. Generally, people would say it's between 4 and 5%. Actually, that does go up the older you get. But let's say you're around retirement age, 60, 65, you're looking at 4 or 5%. What that means in reality is that you would have had to save about 20 to 25 times the annual income you want to take home. And that's quite a big number.
It's a massive number, Bjorn.
So let's just pause for a moment. So if you need 50,000 Rand a month gross to, for example, get 40,000 net tax, after tax, 50,000 times 12 is 600. times 20 to 25 means you need 12 to 15 million rand. And you haven't even got your lifestyle goals factored in.
Exactly. And Alec, that actually is precisely the number you mentioned in another podcast. So go listen to that, folks.
The actuary coming out in you there, Bjorn.
No, the
I'm glad
stats,
somebody's listening to our podcast.
No, there's lots of people listening, Alec. There's lots of people listening.
And that's back to another number you mentioned just now, the 48%. So on that, and the survey we did, so just quickly on that, this Just Retirement Insights, that's the 7th one we've done, and yes, it was 446 people around South Africa that we interviewed. We try and get a good quota of different locations, race, gender.
So there's
name
diversity, Bjorn.
Exactly. So make it as representative as possible. And what that said is that people expected in an income of, on average, 10,000, let's just make it round, 10,000 per month. For that, if you do the math, you would need to have 3 million in the bank to do that. Yet, on average, they have 1.6 million. And that's that 48% shortfall. And I think that's a big part of why we're here today, to take that gap between expectation and reality and see what tools, what information we can provide people to just think that through and understand, raise awareness, but then hopefully we can also help with a few solutions, a few ideas of how you can solve that.
Yeah. And if I can just mention, I'm not going to unpack it now, but towards the end of the episode, we'll talk about a real life example where we've taken a client who was on that pathway of 13 years and we managed to get the retirement journey or expectation of the plan to last for more than double that. And that's quite significant. So if you want to find out how you can prolong your retirement, make sure you follow through. We first want to unpack a few other things. Andrew, you want to come in there?
Yeah, I think, Alec, the key thing for me is maybe let's just unpack that journey now. So we've touched on living, high level, life, and blended. So the thing where I get really excited, I think a couple of years ago, obviously, I engaged with you, Bjorn, in Cape Town. Alec and I were chatting virtually about this blended solution, right? So Alec referred to a little bit earlier in the program with regards to, let's call it sandwich generation, right? So we've got these people that are approaching retirement or are in retirement, are facing challenges, okay? But then we've got this younger generation, like Alex said, someone my age, 40 years old, call it a little bit younger, a little bit older, also got a young family, okay? But there is a solution out there, and like Alex said, we're going to give a practical example or two. But I think from my side, Bjorn, I would love for you just to unpack that blended solution. So how we bring that living annuity and life annuity together.
Fantastic. And I mentioned what a life and a living annuity, what both of those are. And for long, we've seen that it was a binary choice. You had to choose the one or the other. And then there's 10th Wonder came around. And if you're wondering why 10, again, go listen to the other podcast.
We're going to get to like the 42nd
exactly.
wonder of the world at some point.
And it's probably like many of the other wonders. They've been around, or someone just had to discover them or tag them. But what that is about is that really, why limit yourself to choosing the one or the other? Why not combine the two? And why that is so pertinent is, I mentioned the safe drawdown that you can only or should try and draw down 4 or 5% from a living annuity. Life annuity rates or the income you can get from those are higher. It relies on the pooling concept, an insurance concept, where those who die earlier than expected subsidize those who live longer than expected. So on average, the pool is okay. And that literally just means you get a higher income rate than this safe drawdown rate where you are self-insured. And because of that, that stretches you more, but you may not want to or have to go fully into a life annuity. But combining the two, you then increase the combined income rate that you can sustainably take. And Bob's your uncle. And you can dial that how you want. Anything between 0 and 100%. And that has really just opened up many doors in South Africa. Yes, it's combining two things that maybe up until now you've thought about the one or the other. So you have to think through that a bit, but it's not that complex. And it's coming. I mean, there's a lot of people who we've seen have done it with success already, and there are more people going into it.
In my mind, it's the best of both worlds. And when Alec, you and I sat a couple of years ago and sat down and looked at the solution, we'll be honest in that we didn't really, obviously we knew of life annuities, right? But it made us think of life annuities and living annuities in a totally different way, right? And like you said, Alec, we're going to speak about a practical example, but I think a lot of people almost have tunnel vision. Okay, they are stuck in their ways. And I'm speaking about us as financial planners, right? Alec, I'm not pointing the finger at clients or at Bjorn. The default, for example, living annuity, if you're drawing 6%, you might survive 7%. But maybe, Alec, just to throw you under the spotlight is from I don't want to go into sequence of return risk. We have touched on it in a lot of detail, but we speak about a safe drawdown of called 4-5%, but you mentioned 7%. Maybe just highlight the pressure that puts on a financial plan and longevity of capital if you get off to a bad start. And for example, you've got a drawdown of 6%.
Yeah, well, the high drawdown rate can hurt a portfolio massively when you get a bad sequence of returns. So, for example, let's use the global financial crisis as an example. The market's tumbled 30%. Let's say you've got a 10 million rand living annuity and you are drawing, let's say, 6%, which is 50,000 rand a month. And suddenly the markets drop. And yes, the equity markets might have dropped by 30%. A balanced portfolio typically drops about 10%. Well, you had 10 million, you had to draw 600,000, but your 10 million also dropped 10%. So at the end of that year, you've got 840,000 rand. You can never recover from that. So sequence of return risk protection is very important when you construct a portfolio, I believe. And one of the best ways of countering this is incorporating a life annuity. And the nice thing about this, and you mentioned in the past, you had to make a choice at retirement. It was one or the other. The beauty is now you can have this blend, and you don't have to make all the choice at once. So I would say caution, beware of going 100% into a life annuity. Understand, because you want flexibility. So a blend would be great. And if you've gone into a life annuity, you can never come out. Okay. But if you're a living annuity, you can transition 10%, 20%, 50% into a life annuity. And practically, how is that happening? Do you see that in Just?
Absolutely. And just the other day, we had a look at these, what we call tranches, so tranche sizes. And the behavior is interesting. Many people do go in once off. They know that, let's say they need a 50%, we call it a blend. So they need a 50% blend, they go into it. But many others also transition into it. They dip their toes maybe, or they have what we call a gliding path strategy. So they go into that. Maybe just to touch on this, the sequence of return risk or that worry. And that came up in the survey again, that only 8% of people we interviewed said that they can afford to lose 10% or more in their portfolio. And I understand that. So people don't have that capacity for loss. And back to the drawdown rates or the combination, when you reduce your drawdown rates, you are just not selling as much in the low price environment as you need to. And certainly the combination then of the two, this life annuity continues to feed an income, and you can draw that and you don't need to sell your assets. And that's why the combination, but certainly also just having a low drawdown rate just gives you a lot more capacity or ability and resilience to sail through that storm.
Gents, as everyone can see, we're so passionate. I think we could go on for hours and hours. But I think the key thing from my side is what I'd like to unpack now is also longevity. Okay, and I think once again, Bjorn, when Alec and I have been dealing with you, you guys do a massive amount of research. So I'd love for you to unpack your learnings and research findings from a longevity point of view, because I think a lot of people out there think like, 80, 82, 83, 85 is a great number. But based on the research and findings out of Just, that number is totally different.
Absolutely. And what we find are, and it's probably three interesting things, and it starts with, on average, people saying that they are above average health, which I find is fantastic. The optimism around that is great. And I really do value that. Yet, when we ask them what you think your life expectancy is, they typically underestimate that by 5 to 10 years. So let's add a little bit of numbers to it. Now, life expectancy varies by how old you are now, but let's say from age 65, your total life expectancy for the kind of people we work with are in South Africa 82 for males and 87 for females. And then interestingly, both males and females guessed that at around 77. So males underestimate by 5 years and females by 10 years. So those are the two things already. So they think they're quite healthy, yet they underestimate life expectancy. But the third thing I find more telling, and maybe that goes into a little bit of the stats around it. We talk a lot about life expectancy, but we forget that that's literally the point at which there's a 50% chance of living beyond that age. And that's the thing that you need to really consider carefully when you do your financial planning around retirement. So you can't work just to that point and expect that you're going to keep over.
It's almost like you've got two boxes. Which box are you in? The one that's going to exit prior to 82 or the one that's going to exit after 82? And if you're in the one after 82, you need to make sure that you've got enough capital or income.
Absolutely. And that's why generally they would say the rule of thumb is aim for age 95 when you're a male and 100 for a female. And the reason, by the way, they say that is that generally has around a 10% probability of living up to that point. And now we're talking about a plan that's sustainable, that makes sense.
Yeah, and the other big plus is with the life annuity and the way, and you being an actuary, you would know, the actuaries actually basically work it on the mortality rate. So you're getting a rate where if you check out at mortality age, you've actually probably got your full value out of the life annuity. If you live longer, it's like you've got this bonus.
Absolutely.
Yeah.
And it's exactly that. We when we refer to it, we talk about survival credits, and it's really just by being in the pool, you already get that. But it is especially when you live beyond life expectancy, which has a 50% probability, you're truly getting that return kicker, a very valuable thing in retirement.
What we also find, and this is interesting, though we're going off at a slightly different tangent now, life annuities don't only enhance the longevity of a plan, they can help to create more wealth because you've got this lower drawdown rate. And we've done a lot of work on this, Andrew. And I remember when we were doing a lot of research, I was, looking after your mom's portfolio and whatever. And I said, and your mom's really provided well, for her retirement, or your late dad certainly provided very well for your mom. And I said, well, why don't you consider a portion into a life annuity, reduce the drawdown on a living annuity, and there'll be more capital later on in life. So you can actually use it to actually, enhance so you can actually leave two great legacies. One, not to have to knock on the children's door, and two, if you do live longer, create more wealth to leave behind for the kids, because you take some of the capital to buy the life annuity, but on the low drawdown rate, it helps accelerate the growth of that capital.
Absolutely. And that's a common behavioral aspect we sit with, that we all worry more about dying today and tomorrow. And I understand that. And I think COVID has probably heightened that anxiety. Yet if you think through what you'd expect, how long you'd expect to live, there are many papers out there that prove that by actually combining the two, you extend even the capital legacy, which is counterintuitive. And let me just explain to everyone why we say that. Within a life annuity, as I mentioned, there's a pool, but it does mean that when you die, the income just stops. You don't get, you can add
unless you've got 100% spouse income, those type of things. Please, we're going to look after couples here.
Can you guys please use the buzzer next?
Sorry, Bjorn.
But yeah, unless you add benefits, we've been talking about this too much, guys. But absolutely, and that's I think the counterintuitive thing. But because we so badly want to leave money for the kids, we focus on that element too much, and then again, but what practically happens, so many are then dependent on exactly the ones who they wanted to leave money to, and that's what we want to avoid.
Just to add to that point, sorry, and this just goes back to the whole opening couple of minutes of today's podcast. People, or should I say once again, financial planners have tunnel vision, right? And you've got to broaden your horizons. You've got to approach this sort of conundrum differently. And the way Alec and I positioned a life annuity from a wealth generation point of view, Bjorn, I'd like to hear your opinion in a couple of seconds, is that it's a totally separate asset class, right? And rightly, like Alec, you brought up now, when my mom bought a life annuity with a percentage of her living annuity, her starting drawdown at the age of 72 was about 9%, with a 6% escalation and a capital guarantee. So people are so focused a lot of the time on legacy, but there are certain scenarios when tying up a certain amount of money in a inflexible solution, for example, like a life annuity, is actually potentially going to create more of a legacy for heirs, Bjorn.
Absolutely, and that's that 10th wonder we were talking about. And it is the way to think about it, is that it is, yes, a slightly different type of asset class, but it is just an asset class which, particularly for drawdown scenarios, decumulation, is totally worthwhile considering. And yes, it can actually create wealth. And always, when in discussions like this, there's even sometimes reverse scenarios that if you think through, and I mentioned you have to draw down 2.5% minimum. I have seen people put exactly what's needed to pay that into a life annuity, and then ironically, they then only draw down 2.5%, so they're in that lucky position. But then they essentially have guaranteed the capital legacy, because that income that they have to take is now guaranteed, and the rest then, counterintuitively, is literally guaranteed capital legacy. So
what I also found, listening to that episode you were on Asset TV, was it Sharon, the lady?
Yes.
And Sharon used an example of taking a certain amount of capital to secure income to cover the medical aid. Mm-hmm. And obviously, if the one passes, well, then you only need half of that amount. So you could have a reduced pension, which increases the rate.
Essential costs.
Absolutely.
Pretty much.
And I'm going to come back to that example I wanted to mention earlier, and then you can perhaps come in. But something I've also learned in my 25 years in this profession is that when people are young, approaching retirement, they're all focusing on, well, what if I die tomorrow? I need the capital to go to my kids. 10 to 15 years later, the conversation changes. And the client starts to say, well, I need to be sure I'm going to have income that's going to last longer than I'm going to live. I don't want to have to knock on the children's door. And this is where this example came in now. So, and this is just one of probably 40 or 50 cases that I've actually done, or where I've transitioned families into a blended product. And this client was 72, his wife was 71, and his drawdown was getting too high. It was at about 7%. So, previously he wasn't worried. Now he's starting to get worried because, what happens if I live beyond 80 or 85 and so forth? And then I said, well, I need to introduce this to you. So it was 7.5% was the drawdown. So if he needs 7.5%, and we can get a life annuity, which I managed to get, of 10%. The rate was 10% with 100% spouse income, right? So I said, let's take half of the money. Let's say it's 10 million rand. So 10 million rand will give you 750,000 for the year. Let's take 5 million. We get a rate of 10%, guaranteed with escalations, and guaranteed for both you and your wife. That means on 5 million, you're going to get 500,000. Now you only need 250,000 from the other 5 million. We'll leave that in the traditional living annuity. The drawdown will be now as low as 5%. Now the one half of capital is going to be guaranteed for life, even if you live to 150. The living annuity 5% drawdown is going to get you beyond 30 years. We've more than doubled the duration of that plan. That gentleman had tears running down his eyes in my office. It was just astonishing. And we've managed to do that to help people whose drawdown is too high. Perhaps and it's not through lack of trying. It was just there was a lack of capital adequacy at retirement. And they're forced into the situation. And if the average drawdown in South Africa is 7.5%, it means that 50% retirees are in the same circumstance as this gentleman was. And 50% of those retirement plans can potentially, maybe not all of them, but many of them can be. I remember there's a slide you've got of the danger zone, the risky zone, and
yes.
the safe zone. You want to touch on that a little bit?
Yeah, so let's talk through that. And back to your example, and what's so beautiful about that is that they didn't have to change how much they're drawing down.
Correct.
They're still drawing down the
Same lifestyle.
7.5%. But the plan now is a lot more sustainable. And if they didn't do that, we spoke about safe drawdown rates, they would have probably had to go down to 5% drawdown just to make sure that remains sustainable. And I don't know how much salary
Can drop
knocks.
20,000
I
rand a
don't know how
month.
much salary knocks you
No.
guys can afford, but that's a tough pill to swallow. But then, if you look at the stats in reality, what we do see, and I think we've done about 40,000 living annuitants by now, where we go and map them by drawdown rate and age. And then we say, well, how many are in the safe zone? So they are drawing down at or below the safe drawdown rates. And we found that only 33% are in that zone of people. By money, it's a bit more, because generally they're wealthier, the lower the drawdown rate. And then on the rest, and we've split that into two other zones. The one is called the risky zone. It's when they're drawing down between the safe drawdown rate and what we could get from a life annuity, so the 10% that Alec mentioned in his example. And then, in a way, boringly, a third sits in there and a third in that top zone, which we call the danger zone, because they're drawing down rates even above life annuity rates.
So even a life annuity would not be able
Not be
to
sufficient.
put them in the same position.
Absolutely.
They could secure income for life, but they might have to take a salary cut.
Absolutely. And we're not going to do Top Gun themes today, but that highway to the danger zone there can be a dangerous highway. Yeah. And what happens there is, if you're in that risky zone, so let's take again your example. If they said, no, we'll try luck, the happy-go-lucky South African attitude, that may cause a slide, that every year the drawdown rate increases, and then you may end up in the danger zone. And then either you'd have to fully annuitize, so buy a life annuity for everything, but at the same time, you may then even have to reduce the income you get, because you heard now you're even above a life annuity rate. And I think that's the thing that should go through in planning and thinking, okay, but what are my options today?
Can I just add, if you think out of the box, there's so many opportunities. So I want to give you an example of a couple where the wife has got a certain amount of assets from the sale of a property, and it's enough to sustain her life. Okay. The husband has a R1 million life policy and got an expensive premium. And I said, lend him or donate R1 million to your husband. He's much older. We'll take a life annuity. We've got a rate of 18.5%. So that you're getting an income of 185,000 or 15,000 Rand a month. You're easily paying for the premium. You've got 10,000 boost to your lifestyle. And when he dies, the R1 million comes back into your plan from the life cover. So there's many ways you can use these things.
Fantastic.
Yeah.
And Alec, just adding to that point, and we've also once again with Bjorn had many conversations with regards to timing that shift, right, into a life annuity. Okay. And for example, now, and we don't want to go into the technicalities of bond yields, etc., which underpin a life annuity, but I think it's very, very important for our listeners, our subscribers, our clients out there to understand, okay? It's not necessarily about timing that decision perfectly, right?
Yeah.
Because, for example, markets have run very hard or aggressively of late, and what I mean is we've experienced substantial inflation-beating returns, Alex. So values in living annuities are up significantly, even after monthly or annual drawdowns, right? So now if we have to sit with a client, for example, Alec, and say, let's purchase into a life annuity or contribute and transfer 20 or 25% of your living annuity to a life annuity, people might get a bit of a fright with regards to what their starting drawdown is. So I don't want to give too much away from your explanation, Bjorn, but do you mind just unpacking that approach? Because once again, I think it's very much a mindset thing from a financial planning point of view.
Absolutely, and that is a behavioral thing we're seeing at the moment. So in South Africa, markets have generally been doing well in the last 3 years, and we're very happy about that. What we do find, and you mentioned yield, so generally for these life annuities, we invest into bonds to make sure we get that sustainable income as well to pay to the policyholders. And that means we are quite exposed for that calculation to bond yields. And what generally happens though, if markets are doing well, yields are lower. If you were to only look at one side of the coin, so that conversion rate, so let's say for your R1,000,000 that you can get a 7% income rate, if you only look at that, and forget, but your R1,000,000 has actually, it used to be 600,000 and has now grown to 1,000,000. Then you forget that your effective income that you can buy now would actually be higher. Yes. And that's why we've started with something that we bank the rally, or just thinking through that effective income calculation. Otherwise, you are only going to look at that conversion rate and maybe then make the wrong decision. But yeah, that's what we're seeing at the moment. And remember, the converse would apply too. So if you're only waiting for that yield or that conversion, that annuity rate to go up, it will likely happen when markets crash. And then you may, ironically, actually be able to effectively buy less income because
the fund values are a whole lot lower.
The fund values may have dropped more than the annuity rate would have increased. So, and it's back to going to your trusted advisor who's got these things, or asking the questions and making sure that you're making the right decisions.
Yeah, so I think we've covered a lot. We love to cover a lot more. What we encourage you to do is to drop a comment, reach out to us. We can send you more information. We can put you in front of a professional planner who has experience of this type of product, this type of retirement planning. But Bjorn, I just want to say a mighty big thank you to you. We really do appreciate you. You are one of the leaders in this field. We've learned so much from you over the past few years. And our clients have benefited greatly as a result of that. So thanks a lot for coming to join us.
Thanks, guys, and keep up the good work. Lots of education and good information out there. Keep on listening, guys.
Yeah, and Andrew, thanks again to you. And I think I'm always excited about podcasts, but the next episode is on investment lessons from the Comrades Marathon. And we will have some insights from people like Coach Parry, Bruce Fordyce, as part of the build-up. Comrades Marathon, of course, in the middle of June. And there's so many lessons that can be unpacked from the Comrades Marathon. So even if you're not just an investment interest, if you're a sporting interest, you'll find the next episode really exciting. I hope you will. And thanks, everybody. And don't forget, please, to subscribe. We would really appreciate that. Thank you.